Stocks continue to rise while the US dollar stabilized yesterday ahead of today's US GDP report and tomorrow's PCE print. So yesterday, leaders in the stock markets traded more cautiously as previously underperforming stocks rebounded, indicating potential portfolio rebalancing going on into the second quarter of this year when an eventual interest rate cut from the US Federal Reserve could further stimulate these reflation flows. So welcome. This is Swissquote's Daily Market Talk. So European stocks renewed record yesterday. The US dollar consolidated gains and the US trading session got a wild swing by the end of the trading session as the S&P 500 stocks, which were mostly calm for the most of the trading session yesterday, spiked into the closing bell. So the S&P 500 closed 0.86% higher yesterday near an all-time high level, while Nasdaq gained 0.39%. Now, interestingly, yesterday's price action within the stock markets pointed at a possible end-of-quarter portfolio rebalancing, as the session saw the laggers of the quarter like Apple and Tesla gain, and the stars of the quarter like Microsoft and Nvidia retreat. Nvidia, for example, fell 2.5% yesterday, a move that many thought was due to portfolio rebalancing, where you can't have more than a certain percentage allocated to a stock or to a class of assets. And it would make total sense to reduce the Nvidia holdings in a portfolio, given that its relentless rally may have led many portfolios out there to be overweight in Nvidia stocks. Also, regarding the potential market moves due to portfolio rebalancing, while Goldman Sachs warned that the pension funds are likely to sell $32 billion worth of equities for rebalancing the portfolios in the second quarter of this year. So that would have a slowing impact on the equity rally, although the rebalancing act will hardly change the overall market trend, as there is still a lot of cash in the market sitting on the sidelines that could flow both into equities and bonds and keep the rally in these markets quite intact. So the only thing that these markets and investors need is, the Fed rate cut dream to stay alive for the June meeting. And for now, that's pretty much the case, because activity on Fed funds futures gives around 64% chance for a June rate cut from the Fed this year. But also, note that this probability was around 75% last week and, is coming gently lower, as many investors also think that the Fed won't be able to cut the interest rates with this robust economic growth and bumpy inflation. And indeed, the US latest GDP update is due today and is expected to confirm an above 3% growth for the US economy in the last quarter of last year. And that number would be down from a nearly 5% printed a quarter earlier. And as I keep repeating, these are nowhere close to recession level figures. So this is perhaps why the US dollar is not really willing to give back gains these days, despite a relatively dovish stance from the Federal Reserve last week. So the US dollar index is up by around 1% since the Fed plotted a 75 basis point cut for this year last week and said that it will also start slowing the pace of QT. So looking at the market as a whole, I really think that something must give. So that something would either the US dollar should weaken because the Fed is expected to cut 3 times this year, with the first rate cut due in June, in which case we could actually continue to see the laggers of the stock markets catch up with the leaders of the past few quarters. And in this context, note that 8 of the 11 groups of the S&P 500 trade with a discount to their pre-pandemic levels. Yes, you heard that right. Despite the all-time high levels of the S&P 500, 8 out of the S&P 500's 11 sectors are lower than their pre-pandemic levels, because only technology, materials, and industrial trade with a premium. So you could reasonably expect some capital to flow into the well, other than technology sectors and other than technology stocks, while still expect capital to continue to flow into the technology stocks in the continuation of the AI rally. And in the case of policy easing, as predicted to happen, appetite should also broaden to small and to mid-cap stocks, to EM funds, and to commodities. So that's one scenario. Or if the dovish Fed expectations sour with robust economic data and hot inflation, well, the US dollar then should continue its recovery on the back of a pullback in Fed cut expectations, in which case we should then see the stock markets give back some field. But both a strong US dollar and a rally in the US stock markets, well, may not be sustainable together in the second quarter of this year. But my mind favors the first case scenario though. So the Fed rate cut scenario, as the Fed has a political clock that's ticking higher into the November election. And the Fed officials know that if they want to cut their rates this year, well, they must hurry and do that, well, into summer. So that's the only reason why I could imagine the US stock markets continue their rally, the rally to broaden, but then the US dollar should weaken as a result of it as well. Now, in Europe, things are less complicated for once, and happily. Well, Eurozone is not doing well. Well, that's one thing we all know, and that's a reaction, a result of higher interest rates in the Eurozone and, well, this energy crisis due to the Ukrainian war. Germany, for example, is expected to rise 0.1% this year. It's more a stagnation than a rise, mind you. So the slowing European economies and the gloomy growth outlook for the next quarters, well, back a June rate cut from the European Central Bank. Yes, but the European Central Bank says that it won't commit to other interest rate cuts beyond June before they make sure that inflation in Europe is on a solid path toward their 2% policy target. And indeed, well, inflation numbers from Spain that came in yesterday confirmed a rebound in consumer prices in March, as well the Spanish government continued to remove its support that actually helped previously tempering the otherwise unbearable rise in energy prices for people. So yes, the last mile in reaching the 2% inflation goal for the European Central Bank is not a given. And well, that's also certainly why the Eurodollar is holding ground near the 108 psychological level, is simply because the ECB looks determined to continue fighting inflation in the Eurozone. But a robust GDP and a hotter than expected inflation report from the US this week could eventually break the back of the Eurodollar bulls and, well, change the outlook to something a little bit more bearish for the euro. Now, elsewhere, the sumo fight between, well, the Japanese officials and the Japanese yen bears, well, remains quite intense these days, as the Japanese yen bears are, well, really testing the Japanese officials' nerves near the 152 level. Now, the thing is, this threat of FX intervention slows the yen sell-off, yes, at the current levels, but we saw that in the past that, well, the intervention effects remain, well, quite limited when the market is turbocharged with opposite direction trades like we see today. So any pullback that we might see in the dollar yen due to a threat of intervention or an actual intervention itself could actually remain quite short-lived. So the upside potential will obviously depend on how fiercely the, well, Japanese officials are willing to defend the Japanese yen and slow or even reverse the yen sell-off. But at some point, I think that hint regarding further policy tightening from the Bank of Japan could be more effective than just costly and barely effective FX trade. So until we get to that point, I think that the positive pressure in the dollar yen will remain. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. So I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. Yes, I will be here for tomorrow, and until then, good day trading.